Hi everyone. Today we're going to be talking about the Australian real estate private credit market. This comes off the back of a recent research report that we put out around called From Little Things, Big Things Grow. And the basis of this report was really around the extraordinary growth we've seen in private real estate credit in Australia over the last 5 years and the last decade. It has now emerged as one of the number one asset classes in commercial real estate. And today we're going to go through some of the key points, what's driving it, what are the different categories, what are the return profiles, and also what the outlook is. And I'm joined today by our resident expert in all things Australian real estate private credit and CEO of RW Capital, George Ajaka. And George and I will be talking through some of these slides and talking about things that we're also seeing in the market and how they're influencing these particular themes. So from a key takeout point of view, Australian real estate private credit is going through a very strong demand-led growth thematic at the moment. It is now Australia's number one investment class by annual investment income. Now, that is a record. It's the first time that that's occurred. Historically, commercial real estate equity has always been the number one asset class in Australia, averaging somewhere between $40 to $50 billion a year in turnover transactions. As of today, there's over $50 billion a year being placed into Australian private credit, and we're forecasting that to grow as we move ahead. Now, the forecast on where that number is going to go varies greatly. There's a lot of groups out there that are putting different numbers out, and none of them are all going to be perfect, but the thematic is definitely pushing in one direction. So our view is that by 2034, over the next decade, this market will be at least $154 billion out of the $600 billion annual commercial real estate debt market, and it could even be higher in some cases. Australia has been a leader in the region. One of the challenges around getting set in real estate private credit in the Asia Pacific region is finding a deep market with good regulations, good transparency, and good underlying fundamentals. So a majority of the capital coming into Asia Pac focused private credit strategies has focused on Australia, where we represent about 35% of the market. Other markets such as India, China, and others are growing very, very strongly, but due to regulatory reasons, transparency reasons, we're seeing investors still be quite shy about those markets and instead focusing on Australia, Singapore, South Korea, and Japan. Underpinning all this, though, is investor preferences being driven by a higher for longer thematic. Higher for longer really means a higher rates environment. And as a consequence of that, the return profile investors are chasing now means that they have to have shifted from that zero rates environment that we saw pre-COVID, where 4 or 5% per annum was actually a fairly good return. Now that's the minimum return. You can go into a bank and get a 5.5% on a term deposit. So investors have now shifted their focus around getting 10% plus kind of returns, and real estate private credit has been in that sweet spot for some time, and that has become more and more amplified as real estate equity markets have slowed down. The other issue around that is hedging. So investors are looking increasingly at private real estate credit as a form of downside protection. And that's the unique structuring of real estate private credit. You're taking typically a loan to value ratio of between 60 to 70%, which means that your equity position is protected in the event of those downsides that may occur if the asset becomes unsaleable or if there's issues that you run into from development. Now, that doesn't mean that you avoid risk altogether, but real estate credit, particularly in an environment where equity values are coming under a lot of pressure, is looking more favourable to those investors trying to manage downside risk. So from a fundamentals point of view, and as a researcher, I always look at things from a very macro point of view to start these conversations. Australia has very unique, credentials as an investment destination. And that is, unlike most of the other developed economies, we've had a very low volatility, very low inflation, relatively stable growth environment for the last 30 years. Now, we've seen a little bit more volatility move into that, but the reason that we've been able to sail through some of the storms that our benchmark economies such as Canada, the US and UK have been unable to avoid is we have these fundamentals around world-leading population growth. Our population's growing at about 2 to 2.5%. When you look at migration and national birth rates. Now, that's more comparable to what I would consider like a developing country. If you look in countries that are outside the G20, most of their annual population growth rates are under 1%. So that's been a standout for us. I think also too, Australia is well respected and well regarded internationally as a transparent and well governed market. We have very strict regulations here around how credit and around how investments can be undertaken, and also a number of transparency related regulations. Unemployment's remained low. We're still at 4% unemployment despite a slightly weakening GDP outlook. And on that GDP outlook, it is still looking fairly stable. However, there has been some volatility start to move into that. So I think most people next year are hoping some rate cuts that might come into the market can boost GDP growth yet again. The other part around Australia is that we might only be a population of 26 million people, but we have an extraordinarily deep investment market here in commercial real estate. So all in, the investment grade real estate market for commercial real estate is worth circa $1 trillion, according to MSCI estimates. And now when you look across different asset classes, such as emerging private real estate credit, you're looking at a $100 to $150 billion a year market emerging. So it offers investors a significant amount of depth. And from a regional perspective, if you're looking at Asia Pacific strategies, you want to be able to allocate into a deep market where there's a lot of liquidity and those assets are trading. On the more loan-focused front, though, we have very low mortgage delinquency rates in Australia, and that's partly to do with our regulations, partly because our banks here are very well regulated by the local governments here, and also because we have very strict rules about loan-to-value ratios, particularly in commercial real estate as well. From a liquidity point of view, banks obviously have daily calls on liquidity. They're deposit-taking institutions, and those rules are very well governed, but also underpinned by a government guarantee sitting behind those deposits. And that's been world-leading. A lot of countries such as the US and UK have actually followed these regulations and adopted them. From a loan regulation point of view too, that has an impact. We typically have full recourse loans in Australia, whereas if you look at other markets such as the US, Canada and the UK, full recourse loans are less common, and they tend to lead to more disputes and more difficulties for those investors to get their capital back should the loan go bad. So in terms of how real estate credit in Australia mixes up versus the globe and why we're comparatively lower risk, we touched on some of the loan delinquency rates, but we also touched on some of the loan to value ratios. And George, it'd be fair to say right now that we're seeing far less distress in the Australian private real estate credit market than we are in the US. You read all the horror stories around portfolios going on sale at 80% discounts because of leverage. We're not really seeing that in Australia right now. And from your experience, you've been doing real estate credit for nearly 20 years. Is there a reason that Australia seems to have less volatility than what we see in the US or European markets?
I think, look, it's a great question. During the GFC, it was a rough time for the Australian market. But what was very interesting about the GFC is that it came and went so quickly. It was just so abrupt. And admittedly, our governments across the spectrum in Australia and our large private institutions and our banking sector weren't ready for it. They didn't know how to respond. The whole COVID response and the whole post-COVID response by our relevant government authorities has been a lot more measured this time and a lot more ahead of the curve. Certainly not going to say it's up to standard or it's definitely matched what it exactly needed to be, but it was well ahead of what occurred during the GFC. We didn't have the crisis around our banks. We had stability in our banking environment. Australia's a very blessed country. You've touched on it before. We've got great natural resources. We have a strong banking and stable environment. And look, in reality, we don't necessarily want to talk praise of our politicians, but we do have a stable political environment. We're not this red versus blue concept that you're seeing, not just in the States, but globally now, even through the US. And so all that has meant that Australia has one thing that many other countries around the world don't have. Because we're constantly, as you know, in discussions with international capital, whether it's from the States, whether it's from Asia, whether it's from Europe or the Middle East. And the one thing that's consistent amongst all of them is Australia is on their radar. And it's on their radar because of the fact that Australia has sovereignty. This concept that we're so far away from the rest of the world is now a big advantage. And they look at our economy and they think it's stable, it's pleasant, there's no social unrest or social inequality that we are seeing in huge other parts of the world. So all that has meant that ultimately we have a much more stable economy. We have huge influx of capital coming in from offshore, and then not to forget our own LP superannuation market, which is the biggest per capita in the world. And so as a result, we haven't seen, I guess, a distress. Say office is a great example. You know, everyone talks about office globally. In Europe, it's been smashed. In the US, it's been absolutely smashed. In Australia, yes, we've had write-downs, but nothing like what you've seen globally. And a lot of that comes from the fact that I personally believe I've never seen a time in the Australian market where we've experienced the weight of capital coming into the Australian market, not just from Asia, not just from the US, but now Europe and now the Middle East. You know.
And do you think, to your point around the Australian superannuation funds, we're a $3 trillion pension fund market, one of the biggest in the world. Do you think that patient capital that tends to not gear its investments? So if we look at some of the biggest office buildings and shopping centres around Australia, they're held purely with equity. They're taking a patient 10 to 20-year view versus the US, where you have some of the biggest fund managers, biggest institutions who are heavily geared and now being forced into a position around fire sales. Do you think that's creating that, massive distress that we're seeing here?
Absolutely. Look, you've got to ultimately remember, for many of the overseas pension funds, they're actually insolvent. None of their assets match the liabilities if everyone was to retire or pass away today. Australia is one of the very few markets whereby all our pension funds are more than solvent because the liabilities are not defined in a way. And that's a huge advantage for our market. It means that the Australian pension funds don't need to take on risk like the other US pension funds need to, for example. The US pension funds have such a gap in the assets and liabilities that they're constantly taking risk. And to get those big returns, and in a relatively low return market now, you need gearing. And so they are gearing up. There's huge amounts of debt, which has therefore led them up the risk curve. Absolutely.
And as part of that risk curve too, it comes down to structuring. So a lot of US debt deals that we've looked at, come with back leverage, for instance, and that can be as high as 30 to 40% on the back of a deal because they need to achieve those outsized returns. Back leverage in Australia, far less common.
Look, short answer is I'm actually not sure. I know from our perspective we don't use back leverage for our credit investments, and the main reason we don't use back leverage is twofold. One, we don't need it. We're already generating 14, 15, 16% per annum with an equivalent money on money multiple, which is really important for us as an investment house. So you don't need back leverage when you're constantly year on year extracting those kind of mid-teen returns. To your point, they're huge, risk-adjusted returns, so to speak. Very significant, very lucrative. And the second reason is, look, back leverage, you do lose an element of control when the market turns. And the last, 12 months, we've seen that. We've seen the market, as rates have gone up, we've seen the market come backwards. We've seen liquidity issues in it. And the last thing you want is some back leverage there, restraining what you need to do as a fund manager in order to protect your investor position. And so, look, I know personally we don't use it. There's no reason for us to use it, and we'll continue not to use it moving forward. And look, what's fascinating about the Australian market, I'll touch on this point, Luke, and then I'll hand back to you, but is we're probably one of the very few advanced, stable, mature economies in the world delivering effectively emerging market returns in the credit space. And that's because, look, private credit's been around for well over 20, 30 years and never was called that up until recently. But it's an evolving thing in Australia. It's grown incredibly quickly. And as a result, it's still creating some very strong risk-adjusted returns like emerging market economies. That will no doubt stabilise over time, as any arbitrage does. But there's not many advanced economies able to produce those kind of returns.
And on that perspective, one of the most important look-throughs around private real estate credit is the underlying real estate assets. And it may sound like common sense to say, well, the look-through is, is it an office building, an industrial facility, or a hospitality venue? But the common sense around this is really what are the fundamentals driving each of those asset classes? And the chart here, was recently released by CBRE, where they capture sentiment amongst private lenders and the kind of sectors that they're looking at. And we're seeing here that obviously industrial, residential build to sell, and some sectors such as student accommodation, and then to a far lesser extent, stabilised traditional asset classes such as, office buildings, retail, etc., seeing the lion's share. But you can see a real polarity on that chart there. And if I'm looking at industrial, obviously there's been a very strong demand-led thematic where we really haven't built enough industrial space to meet the demand that's been coming through. And that demand has been very much led, similarly to private credit, around a transition in the industrial economy. We've transitioned from being in manufacturing and labour-intensive industries over to services-based and digital and transport and logistics-based industries, and that's occurred over the last 10 years. And in some respects, that theme has been playing out a long time in the US and the UK and other markets, but Australia was sort of playing catch-up. Similarly with private credit, we're also playing a bit of catch-up. Residential build-to-sell has been a big focus area for RW Capital's portfolio. Do you want to just walk me through that, George? What you like about the residential build-to-sell thematic, where you see it going, and why, in particular, when you look at your portfolio, there's some industrial. That sector has been a large part of the portfolio, residential build-to-sell, and then hospitality. Maybe just walk me through the residential component.
Yeah, of course. So look, as we know, Australians are self-obsessed with residential. It's part of our culture. It's part of our DNA. And yet it's a market where the supply, and I comment here on the East Coast because that's what I'm familiar with, Melbourne, Brisbane, Sydney. I don't know, not that I don't know, I can't comment too much on what's happening in sort of Western Australia and Adelaide, but, we've got this huge demand for overseas migrants wanting to live in Australia, given how attractive it is. We have a reasonable natural replacement rate. It's not as high as what it should be, but it's probably higher than most other advanced Western societies. But we have, you take Sydney for example, its natural landscape is a huge barrier to delivering residential. And coupled with the fact that our planning system is fundamentally broken, and we don't have enough trades and builders to deliver what needs to be built. Melbourne has its own challenges. Melbourne's a great city in that it's flat and well planned, and it's actually easy to grow Melbourne, but it has its own challenges with the unions, and it being able to deliver infrastructure and homes at a reasonable price, an affordable price. Queensland also has its own challenges, not only with the unions, but the way the licensing regime works for builders, huge infrastructure expenditure, the Olympics, and along with the mines. They're competing with the mines. So it's a double-edged sword in the sense that you've got this huge population growth happening both naturally and also offshore. But to fundamentally bring this concept of all these new homes and apartments online is... this target of 1 million homes that the federal government set, that is virtually impossible. It's virtually impossible. It's a marketing gimmick. And so in reality, if you're able to align yourself with a quality delivery partner, whether it's equity or debt, the next 5 to 10 years will be very lucrative, we believe, in that residential build-to-sell market. Because if you're able to deliver quality product in a reasonable time frame, the liquidity is going to be there. The banks love to lend to residential mum and dads, and that demand will continue to only grow as there's an imbalance today, and that imbalance will only continue to grow as well.
So your thesis really around resi is that these headwinds that you've spoken about can actually be your friend.
Correct.
If you can, but it's actually very targeted. It's about getting in there and actually understanding the fundamentals, understanding your partner, making sure they've got a clear-cut strategy around execution and delivery.
That's the key thing. If they're able to be the delivery partner, i.e. the builder, and be able to guarantee almost and underwrite the construction price and program, obviously excluding weather, it should be very, very lucrative for those developer builders moving forward.
And lastly, hospitality, and by hospitality, I suppose I'm just talking about pubs. That's been a cornerstone of the Ray White Capital story. It's been a cornerstone of the Ray White Group with the HTL business. So is that a sector that you still believe in? And if so, why? What's driving your enthusiasm?
Yeah, so the history of, we owned around a dozen pubs between 2015 to 2021, something like that. In hindsight, probably sold out of it too early. But in terms of trade, we still believe in pubs. Absolutely, we believe. Again, pubs is just one of those strange Australian cultures. It's just something that we love. Australians love to eat out. And we love good value, and pubs are exactly that. They're good for food and beverage when you think about it relative to restaurants, a good value. They're fantastic community venues, with the beer garden and the bistro area. So they're big community venues, which also Australians love to be outside, and they love the sense of community. So, it's something that, because it's part of inherent in our culture, we don't think that F&B concept or revenue stream will decline over time. Yes, there are cost pressures, but in reality, at the moment, across our portfolio, the hospitality sector is the one sector that actually is either flat in terms of revenue or growing a little bit, subject to which state and which city you're looking at. In this current environment, I don't know which other retail sector can actually claim that, if you're not Woolworths or Coles, for example. So yes, we do believe in it. We also believe in the fundamentals behind gaming.
Yeah.
That gaming's a sticky revenue stream, and it's had huge growth over the last, sort of 7 to 8 years. We don't probably expect that same level of growth moving forward. However, we don't see it declining either. Interestingly, the last 12 months for gaming in New South Wales has grown around 3 to 5% per annum. In the pub market, I can only imagine maybe some of that has come away from the issues that the casinos have been experiencing. So maybe that's
also the entertainment factor. People, things are tough economically at home. They're looking for entertainment that's affordable,
correct,
and local.
Yes, and local. It's relatively. You're right. It's actually relatively cheap. There is a form, obviously, an element of problem gambling, so to speak, which I in all honesty, look, I don't know how to resolve that. Outside of the fact that I can say for many of our exposures to our current investments in the pub space, I know we don't have. If you look at our exposure at the moment to the hospitality sector, to the pub sector, I think less than 15 to 20% makes up of the gaming revenue, which is comparable, which is actually very relatively low for many pubs in New South Wales, and this is where the social harm is impacting the fabric of societies. They're actually producing 120% of the profit gaming, and F&B is actually losing the other 20%. We don't have any of that exposure, fortunately for us. But I think overall, gaming legislation will improve, and I say improve over time. I know a lot of people like to think about it as a risk. I don't see it as a risk. I actually see the improvement of gaming has come a long way. It's still got a little bit to go, especially around the cashless gaming, which the government's all working towards, and that's inevitable. I don't know when that's going to happen, but that's inevitable, and that will hopefully, I guess, clean up that last element of what perceived to tarnish that industry, which is, in my view, 98% significantly positive for the community.
Absolutely. And look, I think the interesting thread that plays through all of these asset classes right now is particularly on the development construction side. Any of the sectors that have high exposure to construction risk, and unless you have ways to manage that construction risk, are probably going to underperform. And I think as you look ahead over the next 12 to 18 months, stabilised office, retail will start to become more and more popular. I think more investors are looking at those asset classes again because they're seeing a light at the end of that tunnel, particularly around potential rate cuts next year. And we're starting to see more equity interest in those markets as well. So when we look at the 5 key factors that are really driving Australian real estate private credit, higher for longer is one I've touched on before. Investors have reset their return parameters. And having previously worked in a funds management business that was focused on core assets, so core shopping centres, core office buildings, achieving a net return of around 5 to 7% through a cycle was considered quite normal. Now that just would not meet muster. I think investors now typically have a return hurdle, and that's an income yield hurdle of at least 6 to 7%. And in addition to that, they're looking for some capital growth of around 2 to 3%. So the return hurdle now is somewhere between 8 to 12% through the cycle. And that's just because they need to get a relative risk-adjusted return compared to the risk-free options such as bonds or going to your bank and putting in a deposit and having it underwritten by Elbow. In terms of regulatory changes, Two, we're seeing that the banks are starting to withdraw significantly from the market. And this touches on that piece that George mentioned before around Australia has developing market-like returns, but with developed, stable economic fundamentals driving it. And I think that's the key point of difference in Australia. And these regulatory changes are impacting banks more acutely. We're talking Basel III. And the reason for that is banks have daily call on capital, whereas most of the private credit operators have long dated capital that's patient, that can be invested over a 3, 5 or 7 year period into these kind of deals. And as a consequence of that, the banks are really shrinking their risk profile. They're only looking at deals typically with a loan to value ratio of 50 to 60%, something that's very well committed, very stabilized. And as a consequence, banks are moving into a different tier, and that's creating a big liquidity gap in the market that we'll see moving forward. And that rolls into the demand piece. A lot of developers now, a lot of asset owners are coming to the private credit market because they can get that certainty of capital. They can actually create more liquidity options for themselves than they had, say, 5 or 10 years ago, when they probably had a very simple relationship-based lending approach with a major bank. Investor preferences are shifting. They do see private credit now as an asset class that forms part of a diversified portfolio. They want to get those outsized returns or improved returns, but they also just want to get some diversification on the type of things that they're investing in. So they may want to look at private credit because it has those downside protection parameters. They may want to look at it because it gives them exposure to a different sector of the economy. And lastly is around hedging. So inflation has been a massive problem for every economy. Australia is still grappling with it. If anything, we're a little bit behind some of our peer set. Inflation is still 3.5% in Australia. But inflation-adjusted hedging has been a massive driver of investor preferences. And if you're moving out of, say, traditional equity-style investments and you're looking to try and get better returns, you have to factor in that inflationary piece. And you've got to be earning at least above 4 or 5% on your money year on year just to keep the same day value of that money as to when you went into it. In terms of what's driving that credit, and we'll drill into this a little bit deeper, is just the market share. Now, presently, Australia has somewhere between 10 to 15% of the commercial real estate credit market held in private hands. The majority of that, 85% plus, is held by the major banks. And whilst we see that declining slowly, it is still a major part of the economy. So most of the 4 major banks in Australia will still write most of the book that goes out onto these kind of deals. But looking ahead, as every 1% of bank market share falls away, that creates roughly a $5 billion liquidity gap in the market. And we're seeing that liquidity gap go to anywhere up to about $50 billion in a year. It's about $30 billion today. Could be $50 billion by next year. And that gap is not going away. So there are some very long-term structural tailwinds that are feeding into the market share of private credit. And also now we're starting to see another emerging trend around secondary trades. So, looking at other private credit providers that maybe took on loans 2 or 3 years ago, they're looking to trade out of those loans because, to your point, market fundamentals have shifted quite a lot in 2 to 3 years. So those loans that were structured in 2021, 22, and the market was, somewhat more stable, lower rates, construction risks were less present. Now they've moved into a very, very different environment. And do you see secondary trades also becoming another major driver of, private credit within that market? And also, I suppose the interplay within the industry, it's developing enough depth, I suppose.
Correct. Yeah. Look, I think the secondaries market globally is well established for credit. It's not in Australia, especially in the real estate space. Not really since the GFC, in all honesty, to your point. So, whereas, the last 6 months for us as a business, we've been trading in the secondaries market with our peers a fair bit. And that's, to your point, it's problem loans that, not that they can't work through, but as a business, they're not really designed to work through. Many of our peers are fund businesses, so they're really trying to reach 4, 5, 6 billion. They have a set target that they're trying to reach, and a problem loan is intensive on resources and allocation of resources. And so if you're trying to grow your fund in 24 months by $1 billion every 12 months, for example, a problem portfolios will not allow you to do that. Which we're not. We're not really a fund business, as you know, Luke. And so the secondaries market's been appealing for us. We've been able to acquire first mortgage debt at a discount for loans that are perceived to be problematic. Typical story, 70, 80, 90% complete. Cost blowouts, builders either gone belly up and there's a new builder involved, program blowouts, the existing borrower does not have the funds to complete, the existing lenders breached all their LVR covenants, and so there's an opportunity for us to come in, or has been an opportunity for us to come in, acquire the debt, restructure, recapitalise the project and the debt profile. Sometimes you're bringing the existing borrower back into it, or there's no real opportunity for them because they've just lost interest, in all honesty. So it's been lucrative from a risk return point of view. That market we expect to continue to grow in the secondaries market because, like you said, there's the influx of new private credit managers in the Australian space over the last 5 years. I'd like to see some statistics on that, but I know personally I seem to be seeing 2 or 3 every month, new ones. And unless you've been through the GFC, which most of our peers haven't, you probably look at metrics haven't, that's probably about it. When a problem happens in a loan, there is no difference between private credit and private equity, and you need to have that skill set. So a lot of people ask me, Luke, is your credit team separate to your equity team? No, they're not. It's a one team. It's a one team that looks after both books because we don't differentiate. We don't treat our credit book any different to the way we treat our equity book. We live and breathe it every day to make sure that you're ahead of the problems, because there will be problems. There's a reason why they're not coming to the commercial banks and they're coming to you. It is still a lot less risky because you have, to your point, you have downside protection in credit, but you need to be ahead of the problem curves because a lot of the time your borrowers won't be.
And in terms of the return range, Australia has comparatively quite attractive returns. It's fair to say that the US is still the number one market for investors looking to allocate to real estate private credit. It's got an enormous amount of depth and also a lot of diversity in terms of those returns. I should just say with this chart, though, this chart does not take into account back leverage. So the returns for the US and UK and EU may account for some of that back leverage. So Australia, the number we have there, it excludes back leverage. So the numbers could be even higher if some of your fund managers are using back leverage. But I suppose if you start at the 10% and move up to your sort of 20% plus range, you're starting really at your senior, very vanilla, high interest servicing kind of loans. Typically they will, in some cases, let's say, take on a bit of construction risk. So I think one of the myths I'm keen to, I suppose, bust here or open out is that there's been a conflation in the market that lower returns, so that sort of 8 to 10% range return, equals lower risk in every time. And to your point around secondary trades now, are we seeing some of those secondary trades start to come through that were on what was considered fairly conservative loan covenants, fairly conservative kind of deals? Are we seeing some of those deals come back to market looking somewhat less conservative than was previously estimated?
Very fair statement. I can say a lot about this, but I'll say this. As a business, we have not necessarily avoided construction loans, but we haven't been competitive in construction loans. And if you look at the Australian private credit landscape, if you want to grow your FUM as quickly as possible, the quickest and easiest way to do that is construction, because that's where the biggest demand is. The worrying thing about construction loans is you are persuaded to believe that it's a tick the box exercise. And what I mean by that is there's DA approval, tick. You have pre-sales, tick. You have an adequate builder with a reasonable balance sheet, tick. Now, balance sheets can easily be fabricated, as we know. Or change dramatically. Fixed price contract, tick. Now, I don't believe there is such a thing as a fixed price contract anymore in Australia. Maybe 5, 7, 8, 9, 10 years ago there was, but the fundamentals of our Australian market is that there is no such thing as a fixed price contract. You may have a well-designed contract, but it's never going to be fixed price. And so as a result of these tick boxing exercise for many of our peers, they've then therefore priced these at, call it anywhere from an 8 to 12% IRR. And the other problem we see with that, with construction lending, is your money multiple is not going to match your IRR. So if you have a 12% IRR, which is a decent return, let's face it, you're not going to achieve a $1.12 multiple per annum on construction. You'll be lucky to get $1.06, $6 cents or 7 cents per annum. And the one thing that, again, we've been doing it for over 20 years, construction loans are asset management intensive. You need to be across the problems because there are so many problems. And again, being frank here, the construction environment in Australia is not one that has accountability. And that's not just amongst the builders, that's the consultants as well when they stuff up. And so because there's a lack of accountability, it just all ends up falling on the developer, which means that it falls onto the ultimate lender.
The financiers.
So people say, oh, okay, it's defensive in nature because even if we're a first mortgage, we can step in. Yes, you can step in, but the transition from stepping in to actually then re-engaging on site can cost you 6 to 12 months, if not longer sometimes. And so that's what I mean. You need to be ahead of the curve. You need to have your own superintendents managing the projects and making sure the borrower, the builder, the consultants, the architects, everyone's doing the job that they're meant to be doing. So with us, construction, in our view, in the Australian market is underpriced. It's underpriced for the risk that you're taking on. And we're starting to see that change now. We're starting to see many of our peers actually increase their pricing to match that. We're happy to do construction lending, but at
a suitable price.
Correct.
Yeah.
Which most borrowers don't like because the market's offering cheaper pricing, and that's fair enough. That's fair enough. Which has therefore led us to some much better opportunities, to your point, in the secondaries market.
I suppose when we look at Australia in the context of Asia Pacific, and I'm conscious that this is going to go out to a lot of investors in the US and Europe, and when you're looking at Australia, often it's bucketed up into Asia Pac. And Asia Pac on a population basis is the largest region in the world. We've got China, we've got India, then we've got Japan, and then South Korea and so forth. It's a very large region on population. However, on market depth, and having done a lot of work in the Asia Pacific market over the last 10 years, on market depth, it's actually very hard to get set in Asia Pacific. There's a whole range of issues, market depth being one, but also the regulations that underpin that market, the transparency, the investment structures, the tax, all of the complex factors that go into getting set in this region. So quite often we see a lot of offshore capital come into the region with very large allocations. And they go, right, well, we've got this massive market. It's going to be very easy to allocate $1 or $2 billion. But what they find in reality is that it's very, very hard to get set because you have to drill down to that next level, and that's the country by country fundamentals. So offshore investors looking at an Asia Pacific real estate credit strategy will need in some form to have meaningful allocation to Australia. The other markets that they've tended to favour have been Singapore and Japan. Obviously, Japan comes with the downside of the returns being quite low. And obviously, if you're originating capital in the US and Europe, your cost of capital is going to be quite high. So Japan is a challenge, and you're also crowded out by a very large domestic pension fund market. So when you come to Asia Pacific, you're really left with Australia, New Zealand to a lesser extent, Singapore, Hong Kong, some of the emerging economies, and I think the India story, I think the Thailand story, the Vietnam story, all of these countries that are growing very, very strongly are ones to watch over the next years. There's no doubt that India is becoming a far more sophisticated investment market. Their REIT market is growing very strongly, but they still are at what I would consider a developing stage of that journey. So when we look at it now, a lot of offshore capital will start with, look, we're not going to allocate just to Australia. We have to be Asia Pac. They kind of circle around the region, and then they end up ultimately coming back to Australia because they can get depth, they can get transparency, and they can get those sort of investment regulations that are comparable to their own markets. Some of the key risks associated with private credit investing, I think, often gets lost in the noise. There's a lot of very positive stories out there at the moment around real estate private credit, but I think some of the key risks around that are rarely discussed. It is a sophisticated product. We are seeing funds in the market that deal all the way from institutional capital right down to mum and dad retail investors who can allocate as little as $10,000. The challenge with all of these investments, whether you're an insto or a retail investor, is the look through as to the deals that you're doing, what's in the book, how much risk you are taking and over what period. But they are quite sophisticated products. You're not just buying an office building that rents out for a certain rate per metre and delivers a yield. There are a range of other factors that can, unpick this. And, a couple of the key ones we always look at are around credit risk. So, what is the actual underlying credit risk of the person taking on the loan? Regulatory risk, are they going to be exposed to not only federal regulations around the lending, but also on the construction side and the property side, are they going to be exposed to different regulatory risks that could impact the project? Liquidity risk is also another one. Access to liquidity now is sort of divided into two camps. You've got open-ended funds, which offer redemption windows, so you can get your cash in and cash out either on a monthly, quarterly, or annualized basis, or close-ended funds. And what we're starting to see is that those open-ended funds are having to struggle with liquidity because they are having to fund redemptions. So they effectively rely on a model where they've got net inflows of new capital every month, which effectively top the fund up for them to go and invest, but they also use those funds to allocate to people who are redeeming out of those funds. And at the moment, there's a lot of positive investment momentum behind private credit. But having come from the equity side and seeing when things go bad, I can tell you now you don't want a liquidity crunch going through your funds because that will also impact the return performance of the fund. Construction risk is something George has touched on a lot, and this is an area we look at significantly. State to state, there is a number of construction issues going on. We're seeing rising insolvencies. We're actually seeing some of the major builders in Australia potentially being traded and sold. Getting control of that construction vertical is becoming a bigger and bigger focus for developers as well, as they look to vertically integrate a lot more of their costs. Back leverage we've covered on, but also the fund structure. And I think it's fair to say, George, we're unapologetically pro closed-ended. We have been for a while. I've worked the open-ended side of the market. I've seen the closed-ended. I've seen all their pros and cons. But you would have to argue that in a product like private credit, that it would probably provide more certainty and more stability to the investors who are effectively pulled together. They're in a club with people that they don't know. They're kind of entered into a marriage with dozens of other people they don't know. But if you've got that certainty around the capital structure, that as an investment manager gives you the certainty to then go out and structure deals that you can deliver against.
Spot on. Private credit is not a liquid asset class. Yeah. If you want liquidity, there's cash, there's bonds, there's stocks, both Australian and international. There's plenty of alternatives that provide genuine liquidity. Private credit, real estate private credit is not a liquid product. And it's generally, if you're selling your own debt, you're selling it at a point where it's not performing. And that's why you are selling it typically. So in our view, it's not a liquid product. And as a result, we're not willing to create a synthetic form of liquidity because, as we know, in down markets, it's not sustainable. And that just frustrates investors because in reality, an investor will only enforce on that liquidity when they're worried about their investment. And that's the exact time as a fund manager when the market's turning. It's the last thing you want to worry about. You want to worry about the project and how to solve or immune that project from any of the risks that it's being exposed to, especially beyond your own control. The second thing I'll say about open-ended versus closed-ended funds, private credit is expensive credit. And so inherently by nature, it's short-term. It's somewhere between 12 to 24 months. Anything beyond that generally means something's gone wrong. So the fact that it's short-term by nature means that it's inherently liquid in itself. And so yes, we have closed-ended funds, but our closed-ended funds are typically 2 years in nature, sometimes 3 years. And so, when you think about that on your overall investment horizon, that's pretty short term. This isn't a private equity fund where it's 5 to 7 years or up to 10 years. It's a 2 to 3 year closed-ended fund. Loans get repaid and distributed back to investors. And so that's just our view of the world.
That's interesting. In terms of the return spectrum, we've talked a little bit about this earlier, and when you look across the different risk spreads, typically we're playing, in that centre area where we're doing senior loans primarily, but we're also, as a minority part of our portfolio, looking at junior and special situations, which are, achieving returns sometimes of 20% plus. Are you seeing special situations and junior deals becoming more and more prevalent within the market?
Look, special situations, absolutely, because it relates back to the secondaries market. It relates back to problems in the underlying market with, interest rates going up or staying higher for longer. Inherently, you're going to see valuations come under pressure. So special situations, yes, absolutely, because of market conditions, but also because of the fact that you have all these new entrants in the market who've increased their FUM quite quickly, and as a result, some of their loan book is not performing, and there's an opportunity of special situations to restructure or acquire some of their debt at a discount. And I don't see that changing for the next 12 to 24 months. In terms of junior is a difficult position to take on because without a strong deed of priority, you're very much exposed. So it's not something, to your point, that has made up a big portion of our book. It's always been something somewhere between 5 to 15%. And I think over time that may sort of transition towards only being 5%. And the main reason is, as a junior lender, you're kind of the meat in the sandwich sometimes. You know, you're relying on the behaviour of the first, and you're relying on the behaviour of the equity, i.e. the borrower, to inject more capital into the project, which, you know, as a borrower, in our equity book, you have that control. If we need to raise more equity, we do. We inject it into the project. As a senior, if you need to put in more money, get on with the project, you do. As the junior, you don't have either of those rights. But we still do junior for our well-established long-term clients of ours. That's important to continue to support them. But to your point, we don't do a lot of it.
And one of the big shifts I've seen, and correct me if I'm wrong, pre-GFC, mezzanine was probably one of the most common structures used within real estate private credit, and to a lesser extent post-GFC as well. I'm hearing a lot less noise around mezzanine through this cycle. I'm seeing fewer deals done in mezzanine. Is there fundamental reasons for that? Is it, to your point around junior, is it just where people sit in the stack?
Well, private credit pre-2012 was mezzanine.
Yeah.
It was just
It was
mezzanine.
all mezzanine.
It was all mezz because the banks were lending.
Yeah.
The banks were lending 65% LTVs, sometimes non-recourse, sometimes more. And so that slither of private credit was just mezz debt, effectively. So the mezz market was a big market, to your point, and now that's been replaced by stretch senior debt.
Yeah.
And so which kind of just absorbs the mezz in itself. And what you're seeing for a lot of these funds is they'll structure different buckets of their funds. So they'll do, say, a 75% LTV or an 80% LTV. They'll put their income secured fund for up to 65% LTV, and then they'll put in one of their high yielding funds to take the slither of mezz, and they just structure their own or tranche their own debt effectively. So I think there's a fair bit of that happening in the marketplace.
Interesting. I suppose from a diversity point of view, portfolios have typically, and particularly in real estate, been very equity focused. You know, you see most investors, you know, buying the shiny office buildings, shiny shopping centres, looking for that distribution yield, that cash on cash yield. But as private credit, I suppose, has really stepped up in the return stakes. And, you know, we did some analysis, we reviewed some other research across the market as well, and we did some analysis around what a portfolio impact of that would be. And, you know, it can be very meaningful by adding private credit. You can add anywhere up to 200 basis points of a long-term hold across a portfolio, and again give you that meaningful diversification. I suppose as we reach the end of this webinar, I just wanted to cover off on some of the top 5 points that we're seeing for the next, you know, the outlook for this sector over the next 12 to 18 months. And there is going to be a lot of change. You know, undoubtedly we're going to see a movement in interest rates in the next 6 months, more likely to be a reduction in interest rates over the next 6 months. And that'll obviously have consequences for this sector as well as the broader real estate market. However, as a long-term structural trend, that growth thematic about bank withdrawal and private capital stepping in is not going anywhere anytime soon. That thematic is going to be continuous for at least the next 10 years, if not longer. So we're estimating that by 2030, that at least 20% of the commercial real estate lending market will be in private hands, if not more. The fundamentals of Australia's economy, whilst they're slowing a bit at the moment, they still are showing robustness. So we're not seeing that, you know, volatility that the UK and the US are going through. And again, to, you know, the points we made earlier, a lot of that comes from our political stability, comes from a very solid fundamentals of our economy. So we have a lot of capital in our economy, supported by the pension fund market, and we also see very strong infrastructure investment as well. The funding gap that we mentioned is growing though. More and more developers, more and more property investors are leaning on the private market to get access to liquidity as banks start to withdraw, and that's going to continue to grow out to at least 50 billion per annum over the next 12 months. But total returns as a consequence of that are still going to be quite healthy. So our forecast around total returns is that on senior loans, we're still going to see those comfortably above 10 to 12%, partly because, you know, of the funding gap, partly also because lenders in the private space are setting pricing a little bit more competitively than they were before. So we're seeing more of a flight to quality around those loan books. In terms of the sectors moving forward, industrial, residential and hospitality still showing very, very strong tailwinds. However, looking ahead to next year with the prospect of interest rate cuts, valuations stabilising, and our view is that valuations on many of these core asset classes are actually bottoming right now. we may start to see more deals being done in the office and retail space. So I'm going to wrap up the webinar there. I just want to thank you, George, for your insights today. If you would like to get access to our research paper, please contact us. Our details will be on the end of this webinar, and also we'll be providing more and more information as it comes out. Thanks very much.
Thank you. Cheers.